Welcome back to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers, co-host Ian Horowitz at Equity Warehouse. Hope everyone is doing great. Today, we're going to be talking about the 5 things I wish I knew about investing in commercial real estate. I believe both of us are qualified to talk about this topic. After Ian spending years and years and years growing a very large residential investment rental portfolio, he traded up asset classes to invest in a lot of commercial real estate, industrial, self-storage, apartments, warehouse, office, flex space, some land development, a whole wide gamut. I've lent on my fair share of commercial assets over the last 17 years as well. And again, topic for today, 5 things I wish I knew about investing in commercial real estate. You guys are going to love this episode. It's things that are, pretty near and dear of stuff that Ian and I talk about on a regular basis. And hopefully it will help everybody as they navigate into the commercial real estate world.
Yeah, no, I'm excited because we literally, we were talking about this morning. I sat down at my computer. I usually do a little bit of manifesting. I hopped on YouTube, put on some good background music, and there was a video that caught my eye, and it was like the 10 things I wish I knew about this. And I was like, we just talked about this topic. It's one of the ones that's going to come up here in a minute. I was like, man, I should do a video about that. And then I was like, Jay, we got to do a video about this. So I'm super excited. Guys, if you get any value out of this, we don't care about the subscribes, but we do care about the likes and the shares. So if you get any value out of it, please feel free to share it. So with that being said, let's hop right into it. And I would say the number one learning lesson that I've had so far is staying local. And when I say staying local, staying in a market that you 100% know and that you can dominate and execute in. And the reason I bring that up is because we have invested in some properties that are afar from us. We started by going about an hour away to West Virginia, and then we started buying stuff out of state, like way out of state, Louisiana, Texas, Arkansas. We're based out of the East Coast up in just outside of Philadelphia. So that being said, it's like, we don't know the exact path of progress. We don't know the ins and outs of the city. We don't know what's changing or when we start to see things changing for the good and or for the bad. And by operating in a local market, one that you've grown up in or that you lived in for a long time, or you've studied so much that you know every in and out and you're tuned and locked in, I think is a massive competitive advantage from an operations standpoint anyway. I don't know about a lender, but from our side of the house of being operations, it's vendors, it's other people that you know in the market that can help you out. It's other capital investors who understand that market because they live nearby it, so they can like feel it, drive past it, understand it. I think there's a massive competitive advantage to staying local.
I think as a lender, it's the same thing. I mean, we only lend locally because it's the only areas that we know. Not only do I know the property values, but I can, meet the real estate investors. I can, spend time helping them grow their real estate portfolios. If we have a default or something, we have people locally, we can go put our eyes on the property. I think that's very important. That's not to say that you can't do this business, out of state, lending, buying. Obviously, every day people are. I just think it's more challenging. And I think that most markets are a big enough market that you can do a good bit of business locally first, really know it, understand it. Listen, if you have a problem on a deal, you'd rather that be local than out of state, that you'd have to fly, hop on a plane and do it. And I certainly understand some markets are easier than others to do business with, right? There's a lot of folks in California that don't want to lend or buy in California because the price points are too high, the laws are too strict. I get it. But I guess a little bit words of wisdom, find another market to invest in and learn that market and stick to that market. And chances are you can 10x your portfolio in that market first before just kind of being a scatterbrain all over the place. So number 2, let's move on to management. In-house management or third-party management. What's better, and what have you learned along the way in your commercial real estate portfolio?
I always hate to use the word depends, but what I will give you guys some insight here is that going into commercial real estate, we had always owned and operated our own properties and did not have any good experiences with property managers. And then we bought some multifamily, so that was a natural fit. And then going out of state a little bit, we wound up using a property manager in West Virginia. And we had really good success. And that opened our eyes to the benefits of having a good property manager in place that can actually monetize their fee that allows you to be free to execute and continue to grow your portfolio. Along the way, we made some bad decisions on some property managers that got really, really tough for us. And we said, screw it, natural selves, let's bring it all back in house. And when we brought it all back in house, there was, there's some issues growing and being vertically integrated. I think there is a competitive advantage in some places to having it all in house. And then there's other competitive advantages to finding the right and the best property manager to operate your portfolio. What we've found over time is that we like to meddle. We're more like tinkerers. We like to keep the assets in good condition. So we probably spend more money than what a property manager may or may not, right? And we might worry about certain things more than a property manager would because it's our own asset. So with that being said, there's certain situations where I believe you should use yourself, and there's other situations that you should use third party. And for us, we want to go back into almost growth mode. So for us, we need to alleviate some of the pain points of the management today and putting it back on third party property managers. But there is such a high level of sophistication when it comes to financial reporting, operations, getting good data sets to actually be able to push out to your capital investors. And that's one thing that we lack in, and just being transparent here, we're not good at all those communication data points. And as we put our property managers in place and we're getting better and better data, that's going to allow us to pass that through. And another point that's going to come up here in a second that we're going to discuss when talking to the banks, you need the proper financial reporting to service your loans. And that's the competitive advantage of having a third party property manager versus trying to build out, and think about the scale that you need to be able to build that in-house to hire the right employees to execute it so you don't have to worry about it every single day.
When we had our rental portfolio, the only way it worked for us is in-house management. We tried external management. We tried a lot of different things. It only worked in-house. And on our lending portfolio, it's the same thing. I know that there's a lot of large hard money lending companies that use third-party servicing people, servicing companies and things like that. We service all our loans internally. I think anyone who's serious about a business in general should, consider taking management, servicing, full control over that. Everything can happen in real time. Yes, there's, cost of employees and things like that and software to put in place. But I think ultimately, if you're serious about growing a business, it's a great way to consider. So number 3 of the 5 things I wish I knew about investing in commercial real estate: financial reporting to your banks, lenders, investors, and partners. I think too many investors in general forget that you're the day-to-day operator. You should know all this stuff. And a lot of this stuff you might know in the back of your, in the back of your head, or you might know because you live it, but there's still other parties involved in the transaction that need to be aware. Your banks, your lenders, your investors, your partners that are involved in this. And you need to have, as far as we're concerned, if it's not on paper and it's not on a piece of software and it's not something that's readily available to everybody, then it's, who knows if it's right or wrong. Like, it's got to be available in real time.
Yeah, no, I definitely agree with that. And knowing just the ins and outs of your portfolio at any given time, super important. But this goes back to the 3 p.m. versus the in-house. If you're going to do in-house correctly, you need to be able to produce these reports to give to the banks. You need to be able to give them to your investors or your capital partners if they ask for them. We would love to get it to a point where, it's readily available to everybody. But there's again, this is in full transparency of like what our growing pains are, is figuring out how to get the proper data to everybody to be able to push this information down the line. With that being said, the other thing is being able to get bank loans, servicing your bank loans. They need the financial reporting for their files. Some of these guys sell them off in the capital markets and it's a requirement. Other people have debt covenants and all these other metrics. You want to make sure that your property and you're operating it correctly allows you to give the correct financial reporting that allows you to continue to get loans from that lender. So that was an interesting one, going from single family where it's like, yeah, we'll give you whatever money you need. And it's pretty simple to, hey, we need your rent roll every quarter. We need your P&L every quarter. We need your year-end financial statements in a timely fashion.
Yeah, I think that's something that we've always done fairly well in our business, to make sure everybody involved can see real-time data. Not just investors, but business partners and things like that. I think that's important to make sure, or borrowers, anyone who's involved in the transaction you should have readily available data that's reconciled in real time or very close to real time. So you can track your numbers and you know what's up. Too many real estate investors don't know what their numbers are at all. They just don't know what their numbers are. And they think they're making money because that's what they have in the back of their head, and they're really not. It's until you put that on paper and you really see what's going on, you're not sure. So number 4 is one that I'm very passionate about in general. I'll let Ian start off with this of what this means, but in essence, number 4 is always for sale.
Yeah, and as Jason said earlier in the intro, we spent the last few years really building a commercial real estate portfolio in an efforts to have these quote unquote equity pops, right? We gave up cash flow initially in exchange to get these big equity pops. And there was a few chances throughout our careers where we were being offered crazy money. And I remember Jason just whispering in my ear, sell it, sell it, sell it. I'm like, yeah, whatever, dude, whatever. And people were whispering in our, both ears saying, hey, you just bought this apartment building and now it's worth $8.5 million bucks and they have to buy it. And you're like, oh, it'll be worth more tomorrow. So, go pound sand. And now here we are sitting going, well, maybe that might've been the right option. So always having your assets for sale, because here's the thing, commercial real estate is actually really, really, really hard to transact. And I think that's why, Jason, if I'm speaking out of turn, they like to have lower lending limits, because commercial real estate, unless it's an insanely good deal, takes a while to transact, and nobody wants to be caught holding the bag. So we were discussing this point this morning. It's still kind of fresh in my head and I'm still sorting it out. But one thing that I was talking to Jason with is, even if it's not always for sale, you should be whispering to brokers. You should be whispering to, again, this is why you want to invest in your own markets, other real estate investors in that market, to say, hey, I might have this property for sale if someone's willing to pay the right price. Because guess what? That pocket listing turns into a real deal. And then you can say, well, hey, here's a prime example. We're selling an apartment building in West Virginia. Right now we make about $100,000 a year, but we'll clear $1.2 million in cash. Well, our rate of return on our trapped equity is less than our monthly cash flow, and we have a ton of inherent risk. So right now we're better off selling that, knowing we should be able to get north of 15 to 20% returns on that new 1.2 million. That should turn into $250,000 a year of cash flow, just for quick numbers' sake. And that's why you always want to be for sale. You should always be looking at opportunities in the market to capitalize, get the big hits, and continue on to the next deal, because there's always going to be something else out there if you just dig hard enough.
Trapped equity is the key word on that. And so many real estate investors fall into that trapped equity position. What that means is you have a lot of equity in a building compared to the amount of cash flow that you're bringing in. I mean, there's endless examples of this particular thing. Let's talk about a residential example, then we'll talk about a commercial example real quick before we move on, because I think this is a very hot topic. So, lots of real estate investors that maybe have owned some properties, they've appreciated over the years, right? So like we had a property that we paid 50 grand for years ago and then put in 50,000, to renovate it, give or take. Our basis was about 100,000, call it, at the time. And, it appreciated in value. It was worth $200,000, right? There's $100,000 in equity. It was a good rental property, and we netted $500 a month, every month, pretty consistently. It was actually kind of passive. We didn't have that many headaches, although arguably we all know that, ownership of real estate eventually takes its toll when there's capital improvements on residential and commercial properties that most people don't account for. But let's just say that all that stuff was still accounted for. We were bringing in $6,000 a year in net positive cash flow, right? $500 a month, not bad for a little rinky dink net, rental property. Well, there's $100,000 of equity in there. What can you do with $100,000 of net equity? Yes, you might have some capital gains and you got to figure out the 1031 and the tax situation. I get all that. But that turns into real numbers. I mean, how many years does it take for $6,000 a year in income to equal $100,000?
6,000 if everything goes exactly right.
Yeah. And there's too many. So that's on the residential side. Let's talk about commercial side. I know so many commercial investors that have, hundreds of thousands, $1 million in equity, right? And technically if there's no equity event, it's trapped equity. That equity is not doing anything for you. It's just sitting there. It's not doing anything for you. And these investors are making they're like, well, I'm making like $30,000 a year on this thing, right? Like that's good passive income. I'm like, it's freaking 3% return, give or take. Take tax complications out of it. I get it all. And depreciation, take reduction of principal on your mortgage payment. I get all that. You just follow me with this point. Like that's not that good of return. You don't think that if you had $1 million in your pocket that you can turn that into a better return? And I think a lot of these investors are scared that they're just going to blow the money and not be responsible about it. But like an asset's an asset, right? That's an asset. Move on to the next asset. What are you going to do with that $1 million? You don't think that you can outperform a 3% return on that $1 million and potentially get into the next asset class up that's better and can perform better? I don't know. That's ludicrous to me.
Yeah, well, and I think a lot of it is too many people are scared to go back and put the work in that it took them to get where they are, and they want to live comfortably. We know an investor. He's done really well, outpaced a lot of us, and took a break there for a good period of time, and now he's trying to get back on the high horse. And it's like, well, wait a second, dude. Like if you just would have continued going, not even keeping your foot to the floor, but just stayed in the market that whole time and watched deals, you would know immediately where to execute. And I think too many people are afraid to sell and then have to execute again. And something that goes along with this point of always having something for sale is you should always be raising capital. And again, if you're selling, and by selling, it allows you to free up some capital. And maybe you don't have to raise as much capital, and you can put more of your own capital into your own deals, because in the end, we should be all running our own investment vehicle that is treated like a family office. And that's the importance of always being able to sell, always looking to sell, executing on that equity, even if it's not the target metrics. I had a long conversation. I'm kind of mixing the 2 points here. A long conversation with a capital investor. And he said, if you're telling me we're not going to hit our metrics, but you feel like it's the best move, we're going to get all of our cash back and then some, and you feel like you're de-risking your portfolio, why wouldn't you do it? Because you're afraid you're not going to hit your target metric? I'm like, dude, you're 100% right. And again, that's the communication you need to have to be doing the right thing to allow you to always be raising capital. And that's one thing that I've learned. Again, it's kind of like I just talked about. If you're always in the game, capital will find you, capital finds the right deals, and it allows you to grow and continue to grow.
Yeah, I mean, you have to be out there every day raising capital and finding deals. If you're not, you're just gonna hit a brick wall at the wrong time, and it's gonna be very challenging. It's very simple to just put one foot in front of the other every single day. It is hard to take big leaps and big sprints, but if you're always raising capital and you're always finding deals, you never run into that problem. One of the biggest mistakes all investors make is oh, hey, we're starting this company. I'm gonna go find some deals. I'm gonna go raise some capital. And they market. They find a bunch of deals, or they raise a bunch of capital, and they start executing on them. They're like, this is great. I got everything. Right. And they did all that heavy lifting, and they got up the hill. And then they stop marketing for deals. They stop looking for capital. And next thing you know, they're executing and they're back at the beginning. And then another deal crosses their plate and they got to start over. Why the hell do you want to start over? You already did all the hard work. Just continue to execute on it. So always be raising capital even if you don't need it. Always be looking for deals, even if you aren't looking for another deal. Let's be honest. When you don't need capital and you have it, good things happen, right? Because it'll be available if you need it. If you're always looking for deals and you can't do another deal at this point, guess what? The next deal you're probably going to do is an absolute home run because you probably cherry picked all those other ones that you've turned down. So hopefully you guys enjoyed the 5 things I wish I knew about investing in commercial real estate. A lot of these are pretty near and dear to Ian and myself. We talk about this regularly. Hope you guys enjoyed this episode. Like, comment, share, subscribe. We certainly appreciate all the support that all of our viewers and followers had. And we have a lot of great interviews coming up on the Real Estate Reserve podcast as well. So make sure you're tuning in on a weekly basis. We usually drop videos and interviews once a week. Until next time, see you later.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.